Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today, we will talk about the national debt, why I think it's important, and how I think it's factoring into the Fed's tightening plans. If you enjoy my content, make sure to give my video a thumbs up and subscribe to the channel. I've been overwhelmed by the amount of positive feedback I've received, and I can't thank you guys enough. Now let's get into it. What I want to talk about today is the public debt and its cost for the economy. There's a lot of talk about where the economy is going, what's going to happen to labor, what's going to happen to earnings, whether interest rates are going to go to 2% or 3% or higher, but I don't feel enough attention is being paid to the debt levels and the cost of maintaining that debt. So we're going to spend some time on that today, and we'll start by looking at this chart here. If you watched my previous video called Hodlers Take a Dive, there's a link in the description below. We broke down this chart, which represents the cost of interest payments on public debt using hypothetical interest rates. And this chart is just a simple model. It doesn't represent the actual way that debt is paid off by the government. They pay that off in tranches, and it's a bunch of different maturities and rates. But it's a simplified model that explains the relationship between growing debt and the cost to maintain it as it connects to the interest rates. So this thick line is the federal funds rate as a percentage of the public debt at a point in time. And as we explored in the previous video, this value seen through this lens has been making higher highs with each cycle and following a pretty consistent trend line. Now, many of these lines represent previous cycle peaks in rates. This brown line is the 16% rate we capped out at in 1986. You can see how this line is touching the brown here. This pink line is 10.5%, which was the peak in 1991. The purple line is 7%, which is where we topped out in the late 90s and into 2000, and so on and so forth. And what's interesting is that even though interest rates have been perpetually declining since this period of time, the cost of the debt, of maintaining the debt, has been rising. And you can see that relationship in how each of these lines is now shooting up above the top of my chart. So what was seen as a reasonable interest rate back in the middle 80s, when debt was considerably lower than where it is now, is showing an exorbitant cost by total debt levels today. Here's that same chart with some detail added down below. This dark line on the bottom half is the regular federal funds rate. This is the interest rate over time that we're manipulating up here to be a payment on debt. This series of orange bars is the public debt. So as rates go down, debt has been rising, and you can see it really started accelerating here in 2008. But what this means, with the debt continuing to rise at an aggressive pace while interest rates are falling, is that the ceiling that rates can be pushed to continues to lower, and it gets smaller and smaller because the debt is growing and there is a constant cost of servicing that debt. So you can really see here the inverse relationship. As rates are falling, rather than the federal fund rate as a percentage of debt also falling, it is rising because debt is growing at a faster pace than rates are falling. And what that leads us to is looking at values closer to 2%, 2.25%, 2.5%, maybe 3% as more reasonable targets for the Fed funds rate, not the 3.8% target that they've thrown out, because just looking at historical precedent, that seems almost unattainable. And much of this is the product of our debt-based system. Debt is what feeds the economy. It's what gives it life and expansion, but is also what is slowly killing it. Here's a look at total public debt going all the way back to the Civil War. Down at the bottom is the 5-year growth rate of the debt. And what you can see is back in the old days, the debt would mostly expand during periods of crisis and be relatively mild otherwise. Back here in the Civil War, the debt was growing by thousands of percent a year. Then we spent many decades with pretty moderate growth and even some contraction in the debt until we reached World War I, when it exploded again. Same thing happened for the Great Depression and World War II. But in between these periods, you can see it was relatively quiet. But then something changed in 1971. That is when Richard Nixon closed the gold window and ceased supporting convertibility of US dollars to gold. And ever since then, US treasuries became the dominant global reserve. And likewise, since that period of time, debt has been perpetually expanding. Note how the behavior of these bars becomes really consistent around this point in time after over a century of being more reserved for crisis periods. But no, since the 70s, debt is in perpetual expansion. If I show you my chart up here at the top, this is actually currently in a logarithmic scale. So each of these values is a 10x from the one below it. If I take it off logarithmic, you can really see the difference. You note the change right around this period of time here, which is just a few years after Nixon closed the gold window. This was a period of time where we had extremely high inflation. Paul Volcker jacked up interest rates to 15-20%, and this began serious debt expansion. And it multiplied in 2008 when QE entered the picture. But you can really see here on a linear scale just how the debt began exploding. Once it passed 1 trillion, right here around 1983, 1984, it just exploded up. Currently it's showing at 28.4 trillion. That's the end of last year. As of right now, we actually have over $30 trillion worth of debt. And the cost of servicing that debt is getting more expensive. So what we're looking at here is the sum total of dollars that the US is actually paying on its own debt. Whereas this is a simulated model showing hypothetical interest rates compared to the debt. This over here is the actual dollars they are spending. At the top, it's monthly, and at the bottom, it's year to date. And you can see each year, it's been getting a little bit higher. It declined slightly here from 2011 to 12, but the trend is growing year over year. 2022 is incomplete yet, but 2021, we paid about $380 billion simply to maintain our debt and keep it in good standing. On a monthly basis, you can see this value going up really quickly. And here in May, the value is $50 billion just to pay interest expense on the public debt. Here's a different look at those values. So up here at the top, I've got some gray bars. Those are representing the interest expense that we looked at over here as a percentage of the public debt. Here in this red line is the public debt. Interestingly, in the late 70s and into 1980, when Paul Volcker was trying to slay the inflation dragon by jacking up the federal funds rate to 15-20%, which you can see down here, those rising rates put an upward pressure on the cost of maintaining the debt as a percentage of the whole. So the percentage was around 3%, 4% of total public debt was being paid on a yearly basis purely for interest expense. And that ballooned up to 7%, which is the highest value that we've got on our chart here. But then this value began declining, in part because of two forces. One force was the growing debt. As we just explored, this is really when it started to take off in earnest. At the same time, interest rates were falling swiftly from an extremely elevated point. And those two forces together lowered this value as a percentage of public debt. What we've got in the middle here is the same thing, interest expense as a percentage of GDP. So it's a percentage of the total economy. Now, interestingly, this also grew here in the late 70s and into the 80s because the interest expense itself was rising because of these rates here and because debt had started to take off. And it stayed elevated. We were paying 3% of our economy every year just to maintain the debt all the way through the year 2000. And then it began to decline. And we've seen a regime of this value being below 2% basically since the early 2000s. And a lot of this has to do with an extremely low interest rate regime. However, in the last couple of years, that trend has started to soften. We're starting to see higher values more consistently of interest expense as a percentage of GDP. And that is in large part because the debt is exploding. And even though interest rates have remained relatively low, you can see that when they began rising in 2016, 2017, 2018, that also put upward pressure on the interest expense as a percentage of GDP. We're paying almost 2% of the economy just to maintain the debt, while it was all the way up here at $20 trillion. Now, these black circles on here, these dots, they are are the government deficit as a percent of the GDP. So the amount of money flowing out as a percent of the total economy. And the US has been largely in a deficit, with the exception of the late 90s, at the end of the Clinton era when the government actually produced a surplus. We've been mostly in a deficit above this zero bound. But here in the last few years, the deficit to GDP has exploded. You can now see it touched 15%. The most recent value from last year is 12%. So the government is spending far more money than it's currently taking in. We're still paying 1.5% of our total economy every year just to maintain interest. And the debt itself is continuing to rise. So if we actually see a period of time where GDP contracts or growth slows down considerably and the debt continues to rise, the debt continues to balloon, or interest rates continue to rise, the cost of maintaining the debt will also go up. And this is a problem because the US does not have spare money right now. They're spending about 12% more than they're taking in on an annual basis. And when we look at this model here, which shows us that maybe we get to 2.25%, maybe we get to 2.5% interest rates. Once that debt actually rolls and becomes part of the new interest rate regime, it could cost hundreds of billions of dollars annually to maintain. Now, I'm not a rates expert. I'm just a tourist who's using publicly available data. But it seems to me that we're running headfirst into a wall where the government will not be able to maintain its debt obligations with current income. They're already running double-digit deficits to GDP. The national debt has risen to 30 trillion. And as we're seeing these monthly values explode, we're very possibly starting to trend back to a period of 2% or greater interest expense as a percent of GDP. And when we were last in this environment, when the US last put up with this level of interest expense, deficits to GDP were less than 5%, and debt to GDP was below 100%, whereas now we're closer to 125. So the debt is ballooning, the deficits are ballooning, the cost of maintaining that debt is growing, and we're still raising interest rates, which will have an effect on these costs on a lag. So when I look at my model here, even though it's extremely simplified, I see a lot of confluence between the values shown here and the exploration of the interest costs on the debt, which currently are about $380 billion annually and rising. Where is that money going to come from? If we're running 12% deficits to GDP, the likelihood is that we will have to monetize to pay our debts. We will have to create new money to service the old money. That is the path our government has been put on ever since we initiated the QE engine. And when you look back through the history of human society, all the way back to ancient China and the Sung dynasty, humans in control of fiat money have one outcome, and that outcome is inflating the currency into collapse. Sometimes it can take decades, it can take generations. I'm not suggesting we're on the doorstep of financial collapse right now, but it is greatly concerning how frivolously our leaders talk about tightening into an economic slowdown without ever acknowledging the cost of the national debt, the debt which feeds our growth. It's what feeds new investment. It's what feeds GDP. It's what feeds the consumer. We've been on this train now for a decade and a half, and it's very difficult to get off of. The US's position as global reserve currency issuer has allowed them to push this beyond where other nations have failed. When I hear economists and world leaders talking about nominal growth, nominal GDP growth, nominal wage growth, but ignoring the effects of inflation and what they're having on the consumer, the way they are weakening people's ability to spend, those risks portend a slowdown in growth. Later this month, we're going to get Q2 GDP numbers, and I suspect very strongly they will be negative, which puts us into a technical recession. Even though, if you look at the meeting minutes from the FOMC meeting from this month, the Federal Reserve didn't mention a recession one time. These are not serious people. control, but they are in charge of very serious economic levers. So I want you to keep in mind the position of the national debt when you hear talk about where interest rates are going to go. Think back to our model here. Think back to this line and the absolute explosion of debt since the 80s. And think about the $380 billion we spent just last year to maintain good standing on our debt obligations. Now, because inflation is so elevated, I don't necessarily know that monetizing debt to pay obligations will be the kind of growth spur that people are hoping for, right? The pivot to QE that is heralded on economic Twitter, that everyone is waiting to see so that they can buy risk assets again. I think because of the debt situation combined with inflation, there's a very real possibility that whenever the Fed comes to this conclusion and they understand that they must be the buyer of last resort, I believe that that outcome may not be as pristine and effective for risk assets that many of my Bitcoiner friends would hope for. We don't have a lot of historical analogs for this exact situation, with receding growth, likely recession, generationally high inflation, and 130% debt to GDP. That is not a combination that anyone alive has seen before, certainly not with the introduction of QE. So I think we've still got considerably more pieces to see play out on this chessboard before we understand the real effects of all this tightening. Make sure you follow me on Twitter right here at TXMC Trades. This is where I post a lot of my charts and analysis. And it's a great place to see when I'm going on podcasts, doing Twitter spaces, and other content. We're in a very precarious spot for the economy right now. Next week is a big one. We've got CPI coming out for the month of June, and Q2 earnings season kicks off in full. So there's a big week of events coming up. It's anyone's guess what inflation will do. We've seen copper and oil and a number of commodities falling hard this month. But if you look at the Cleveland Fed's Inflation Nowcast, which is an algorithm that uses a basket of inputs to calculate where it thinks inflation is going to go, it still thinks we're looking at 8.6% for the month of June, which would be a flat reading from May. We'll have to wait and see how it plays out. If you have any questions or comments for me, make sure to leave them down below and I will read them. And I'll make another video in a few days. So until then, take care of yourselves, friends. Be kind to each other and remain patient. There's still much more to play out in this economic storm. So until we meet again, cheers, everyone.